Hello everyone, in today's video I'm going to be discussing inflation. Inflation is super prevalent in today's society, so kind of talking about it right now I think is very beneficial with how high inflation is. Inflation is defined as a general increase in prices of goods and services over a period of time, and inflation is measured by the CPI, or Consumer Price Index. And the CPI is the percent change in the price of a basket of goods, which is thousands of items, and these goods are going to be goods that are used by everyday consumers. So the CPI is calculated by a bundle of thousands of items that everyday consumers use, so a lot of just grocery store items, stuff like that. And then those prices are averaged out, and then the percentage change of these prices is going to be used in the calculation of the inflation rate. So that's how the inflation rate is calculated through the Consumer Price Index. Right here, I kind of listed out the average inflation, the average monthly inflation per year. And then I have a few years listed here, and then 2 more years listed there. So as you can see, this is the 2021 year-to-date average inflation, and this is through August. Today is September 30th, but this video is going to be uploaded on August 2nd. So year-to-date 2021 is 3.9%. 2020 averaged 1.2%. 2019, 1.8%. 2018, 2.4%. So as you can see, like most of these numbers are going to be right around that 2% inflation rate. And that's because the Federal Reserve has a goal to have inflation of around 2% a year. That's the goal they use. But now their goal is to kind of average inflation at 2%. And that is because previously the average was lower than 2%. So now the Fed can have inflation above 2%. So that way they can say they averaged it out based on previous years that were lower than 2% to actually have inflation higher than it was, basically to stimulate the economy in the short run, which will negatively impact the US dollar in the long run. But the inflation being so high and at a 3.9% is almost double the goal of 2%. So part of this reason is going to be quantitative easing, which is basically printing more money. That's one of the main ways inflation occurs in a society, the government printing money, in this case the Federal Reserve. But one way to combat against inflation as a consumer would be not to save your money in a savings account or checking account that yields very low percentages, but instead to invest your money in something like the stock market, or maybe buy some bonds, even certificate of deposits, which usually yield pretty low because of how low risk they are. But even the stock market historically returns about 8 to 10% per year. Some of these years are going to be very negative, and that's just something you can take into account with your risk level as an investor. But basically, anything over 2%, you're going to be yielding increased purchasing power, and then anything under 2%, you'll actually be losing purchasing power because of that inflation rate. And especially in a year like this year in 2021, where the inflation rate is so high, you're just losing that purchasing power based on the money you hold. So trying to get your money into investments to get above that base rate of inflation will allow you to make more money in the long run and increase your purchasing power. So yeah, that's basically just the overview of inflation. If you have any questions, let me know. Thanks.